Thank you all so much for joining us here for this Charles Stanley webinar, all about financial priorities in your 30s, 40s, and 50s. My name is Erica White, and I'm your host for this session today. So throughout the course of the next hour or so, I'm going to be joined by some of my fabulous and very knowledgeable colleagues to talk through everything that we need to know about these very important decades of life. Now, it's no secret that as we age, our lifestyles, priorities, and obligations do shift. And it doesn't necessarily happen at the same pace for everybody, but it is true nonetheless. Things do change. So with this in mind, we're going to be talking to our lovely experts about the key things to keep in mind through various decades. So before I dive into this agenda, I'm going to do just a little bit of housekeeping. But before we do this, I just want to share a little fact. The number one source of stress for UK adults is money. You guys could probably guess that. So that's above family duties, work, health, or anything else. It's money. So facing into that, spending even just a little bit of time getting your finances organized and making an action plan for your money are all huge relievers of that stress. I'm sure many of you have heard the famous phrase that knowledge is power, and this really truly is the case when it comes to your finances. So well done to each and every one of you. Give yourself a little pat on the back for logging in today, for joining us here for what we're hoping is a very informative, clear, and engaging webinar. Okay, time for a little bit of housekeeping. So as mentioned in our email comms, we just want to remind you guys that this session is best viewed on an actual computer or a laptop, not on a mobile or a tablet. So if you're currently tuning in from a tablet or from your phone, our recommendation is to switch to watching us from a laptop or a desktop computer instead, or else you might not be able to read the slides that we've worked very, very hard on. It will kind of defeat the purpose. Another reminder here, when you're looking at the screen right now, the slides with the text you're currently seeing should be the largest box on the screen, but if that is not the case, please do go ahead and click the right-hand button that says View on the top, and then select Speaker Mode, and you should be able to read and enjoy the slides with ease as the session does continue. So we've done our very best to create what we're hoping is a really informative and interesting webinar for you guys, and we do expect tons of questions throughout. That's actually one of my favorite bits of these webinars. But please do keep in mind that the experts that we have here today are not allowed to give specific individual financial advice. So if you're wanting to pop some questions into the chat box as they come up, and we really do hope that you do, please try to phrase the questions in kind of like broader terms, as opposed to asking anything too specific or anything about specific stocks or anything too nitty-gritty on this forum, because unfortunately, we will have to skip those questions, which we absolutely do not want to be doing. We want the chance to answer as many questions as possible, given the time constraints, of course. Final thing I'll say before we dive in, we will be sending out this recording with the corresponding slides alongside it in a follow-up email, as well as information about how to book a call with some of the experts on the team. So please do look out for that. Okay, let's take a look at the agenda for the session. So we're going to be doing this chronologically. I feel like that makes the most sense. We'll be starting with 30s, then moving to 40s, and then finally to 50s. Myself, Lisa, and Rob, the panelists for today's session, we're having a little chuckle earlier because between the three of us, one is in our 30s, one is in our 40s, and one is in our 50s. So between that and the content that we have on deck, we really do think that we have all our bases covered here. We will then be opening the floor to a Q&A session and a review of key dates with our experts. So this is your chance to ask our professionals any questions that you might have. So questions about the markets, questions about pensions, interest rates, that's super topical right now. That will be the final little bit. Okay, it is time for me to introduce our very first expert. We've got Lisa Kaplan, One Step Financial Planning Director here at Charles Stanley. Lisa is a chartered financial planner using technology to make it easier for people to move forwards towards financial well-being. So she combines digital experience and financial planning knowledge gained over 13 years working in the personal finance space and is the perfect person to lead us off here. Hi, Lisa, take it away.
Hi, Erica, and hello, everybody. Over time, people's priorities, their financial priorities change, and they have a specific investing journey. So early on in your financial life, a lot of your capital is actually your future earnings potential. And over time, that future earnings potential becomes real and past earnings, which hopefully are being transformed into capital in the forms of savings, investments, housing. And then that way, it's natural that the things that you should be looking at change over time. So in the early years, you need to set things off to get the base sorted. Then you need to sort of slowly plan towards the transition to the time when you won't be earning anymore. And finally, at the end, you need to be thinking about how do I transfer my capital effectively to other people. And along the way, you're inevitably thinking about things like helping your children, looking after your family, buying a house and whatever. And those things will change over time. Now I can have the next slide, please. So starting with in your 30s, you need to build your base, and I'll go into more detail about what that is. But essentially, it's making sure the people who depend on you are fine. You need to just start getting going on retirement and sort setting investment goals, and to start the investment journey early. And Rob will be talking in more detail about the investment side of the story. I'm talking more about the planning side of the story today. Can I have the next slide, please? So I said I would talk about what I meant by building your base. These are financial fundamentals that you should do before you start your investment journey. So the first thing is to pay off any high interest consumer debt, unsecured debt. I'm not necessarily talking about a mortgage or a student loan. I'm talking about expensive credit card debt, that sort of thing, which got a high interest rate. After that, you need to make sure that you've got a good cash reserve so that if something happens, like you suddenly lost your job, you've got a bit of time so you can draw breath, and you've got enough money available so that you could cover any unexpected expense. You should also think very hard about protecting your family. I was talking about your future earnings potential. If something happens, that's not there. So if you lose your ability to work for some reason, or if you were, really unfortunate and you were to die, have things in place so that the people who are depending on you, your family, your children usually, will be okay, and that's through insurance. It's often not as expensive as people think, and it's really important to look after that as well. The other thing in terms of you should be doing in your 30s is make sure that you are starting saving towards your pension. If you're employed, you will almost certainly have been sort of given a pension, started a pension by your employer. It's their legal requirement to do so. And they have to contribute to the pension, and they may ask you to contribute to the pension. It's a very good idea to stick with that because you're getting free money from your employer and you're getting into sort of an invisible savings habit for your future. If you're self-employed, you won't be obviously put into a workplace pension, but you can set one up for yourself. And often self-employed people have lumpy income. And at the end of your financial year, you can decide what contribution you're going to make in that financial year. And it's still very tax effective. And I'll come on to talking about that in a minute. And the other thing, often when I see people in their 30s, they don't have a will. Having a will is really a kindness to the people who are sorting your affairs out once you're dead. And I really recommend everybody has a will. It doesn't have to be that expensive either. A bit gloom and doom, I'm afraid, but these are practical suggestions. Could I have the next slide, please? Okay, so I talked about contributing to a pension, and I talk about tax relief. And people, fair enough, don't get why a pension is so effective from a tax point of view. Effectively, you pay no tax. So you get sort of a free uplift, if you like, on the pension contribution. So this example, you can either pay it via your company payroll, in which case the money goes before it's taxed, or you can do it via personal contribution, in which case the pension company will go and get the basic rate of tax relief. So that's the 20%. And then you claim the rest back via a tax return. And after a couple of years, the revenue will recognize what's happening, and you may not have to do a tax return. It may happen automatically. So to use some numbers against that, so if you want to put £1,000 into a pension, what you would do is, if you were making a personal contribution, you would pay £800. And then the pension company would go and get the extra extra £200. So that's how you would end up with £1,000. If you were doing it as a higher rate taxpayer, that first 20% the pension company will go and get, if it's a personal contribution, and you would get the other £200 via your tax return. Again, if you're doing this via payroll, you would just say, I want to put £1,000 into my pension, and you immediately save the £400 of tax you would have had on that. And additional rate taxpayers, this is in the latest announcement, this is now the rate at which you pay additional rate has come down to about £125,000 now. And the additional rate of tax relief on £1,000 would be £450. So these are the rules as they are now, and they're fairly well established as well. People often have questions about this, and that's fine. I'm happy to answer them more later. The next slide, please. Erica, it's back to you now, because Rob is going to be talking about this one.
Thank you so much, Lisa. We'll be hearing from you again shortly. It's time now to hear from our next expert. We've got Rob Morgan on deck. Rob is our chief analyst here at CSD with over 20 years experience in financial services. So Rob has worked as a financial advisor, a pension specialist, an investment analyst, and other things as well. And he currently specializes in researching actively managed funds and regulated rates about investments, markets, and personal finance. Rob, take it away.
Thanks so much, Erica, and thanks to everyone joining us this afternoon. And I think 30s, well, it's a decade, really. I always think of it as multiple competing needs. You've got to kind of save and invest for the future in a kind of methodical way and balance against kind of your shorter term needs as well. So it's really important to set different goals for different pots of money and consider, whether they're kind of short term or longer term in nature. And when we say sort of short term and longer term, we mean kind of shorter term as kind of less than 5 years, as a bit of a rule of thumb. And that might be something like putting aside money for a new car or house deposit or something like that. And longer term goals, Lisa's already talked about getting ready for retirement, so that's pretty much the longer term that you can get. Or it might be something else, preparing for kind of school or education fees for your kids or something, which is kind of 10 years away or something like that. So, there's a variety of longer term needs as well. So we always make that distinction, and short term needs are best addressed through cash savings, and longer term ones through investing. And why is that? Well, unlike cash, the riskier assets, investments don't offer the security of capital, but over the longer term, they do tend to do better and therefore build wealth more effectively. It is something of a roller coaster ride. We know that, we've experienced it certainly over the last 2 or 3 years. And it's best to ride that roller coaster all the way around. You don't want to be getting off a roller coaster halfway around, which is why cash is for the short term. And your goals not only direct whether you save or whether you invest, they also inform you of how you should do that. So the most appropriate type of account for your needs. So we've mentioned pensions already for retirement, and you can also use ISAs, individual savings accounts, to save tax and make your investments work harder for you. And we've got more on that coming up later on. If we go to the next slide, please, I just want to illustrate kind of the downside of holding too much cash for too long. And this is what happens to the spending power of cash, or what has happened to the spending power of cash over the last decade or so. And as you can see, it's really not kept up at all with inflation. That red line is adjusted for inflation, so it's lost roughly 25% of its spending power over that period of time. And that is really why we invest, and why we avoid cash for longer term periods. Even if you're getting a relatively competitive rate of inflation, it can be very difficult to keep up with rises in the cost of living. And unfortunately, that means taking risk and taking on the volatility of stock markets and other investments, and that can make things quite scary. There are fortunately some ways we can make it less scary, and one of those is diversification, which the next slide illustrates. That's the one. And diversification just means holding lots of different assets with different characteristics. And that's aimed really at giving you more of a serene glide there, illustrated by the lazy river. There's going to be some bumps, but if you're using lots and lots of different types of investments, you're not going to have the very large peaks and troughs of the pure stock market. And certainly if you're saving for retirement, if you're saving for a long period of time, that might be okay to go full on roller coaster, because if you're in your 30s and you've got a very long runway until you're taking and drawing upon that money, it's the destination and not the journey that matters. So you can embrace the risk, you can ride the roller coaster, and you can ride it to its final destination. But if you're looking at controlling volatility, if that's too scary for you, then diversification is the way forward. And one means of doing that, one very easy means of doing that, is illustrated on the next slide, which is through funds. Now, if you've got a pension, you'll be invested in a fund, and it will be diversified across different shares or different other investments within a product for you. And it's what we call a collective investment, because it holds a variety of underlying holdings. So you get a ready-made spread across that particular asset class. So it's a package investment. It's like a box of chocolates. You've got different ones wrapped up within it, and that spreads the risk versus holding a one or a single share, for example, which can be risky, which some people like to do, and it can be rewarding, but it can also be very risky as well. So if we go to the next slide, please. And really, the realistic way to invest money is in your 30s. It's going to be little but often. But don't underestimate the power of doing that, because regular investing can really meet your goals if you start early. And even if you save a little bit each month, it'll add up, as these examples demonstrate here. £100 a month for 40 years is much more powerful than £300 a month for 20 years. And you'll actually spend less on those contributions. And basically that's because of the power of time and the power of compounding, getting returns on your returns over the years, so that your money kind of snowballs over time. And that can be really powerful. I've got a picture there of Warren Buffett, probably the most famous investor living today. And he's credited with obviously being a very smart investor. And his approach has led to some good returns. But most of all, what's led to his vast wealth is actually the period of time that he's been around and just compounding returns and not making mistakes, not having those drawdowns in the amount he's got invested that kind of wipes out or destroys the compounding process over the years. And the good thing about compounding is it doesn't just apply to Warren Buffett, it applies to everybody. And all you need is the time and the patience and really kind of the discipline to leave things alone and just let them compound over the years. And starting early can also help you map out your financial goals. So how much money you'll need and when. So this can be a really good exercise sort of early on in your 30s and constructing a kind of plan to reach those goals. And then you'll be better able to judge when and how you're going to be able to meet it. And
sorry to interrupt. I just have a topical question here that we're hoping you can help with. Question here, and if anybody has any questions, please do submit them into the Q&A box. Question here: at what age should you start to pivot from more risky investing strategies to safer investing strategies? Approximately, I know this is different.
Yeah, that's a really good question. It kind of comes back to what is considered short-term and long-term. And I certainly think if you're looking to start drawing on your investments within 5 years, then you do start need to think about that. And you might need to start to think about that as much as 10 years if you're being particularly cautious. But it's somewhere in that ground between sort of 5 and 10 where you really do start to need to think about it. And it also depends on how you're drawing it as well, whether you for instance, are going to convert it all to cash in one go, or if you're going to buy an annuity, which is an insurance product that pays you a regular income. That's different to if you're keeping it invested. If you're keeping it invested, you might need to make less changes and tweaks. So it will depend on the situation. But I suppose in terms of time frame, that sort of 5 to 10 year window is really important.
Amazing. Thank you so much, Rob.
Yeah, so if we go to the next slide, I think, and we're moving on to the 40s here, and which is my decade. And again, there's no one size fits all answer. Situations and objectives are really going to vary according to people, but there is a real hierarchy that you know, when financial planners are looking at your situation, they're going to be going through. As I say, lots of overlap with the 30s, but things definitely do change, and it tends to be when you're moving into your higher earnings years. So that gives you perhaps some more opportunities and some options. However, you also tend to be responsible for more. So you've probably bought a house by this stage, or are looking to do so. So there's mortgage payments to think about. And childcare is going to be a very big one for lots of people. And on top of that, then you're probably starting to think about ensuring your retirement plans are on track as well. So, you know, loads of competing needs in terms of balancing what you need today versus tomorrow. So like the 30s, the general hierarchy does apply though. So the firm foundations have to be built. So what Lisa referred to earlier in terms of paying off debt and building that emergency fund, that all still applies. And hopefully by now you've paid off the expensive debt such as loans and credit cards, leaving just what we call the good debt in form of mortgages, where the monthly payments are under control. Unfortunately, with the recent rise in interest rates, that's no longer a given for lots of people. And if you are facing very high monthly costs, then paying off a chunk of your mortgage is a consideration. And I've got a section on that actually later on of the things to think about. And on top of an emergency fund being built, say sort of 3 to 6 months expenditure and any planned expenditure, that's a good rule of thumb to stick to. You need to be thinking about those insurance policies that Lisa mentioned earlier for your family security. And if those weren't relevant in your 30s, they might be in your 40s. And of course, making a will as well, as Lisa also mentioned, is very important, especially if children are involved. And as I mentioned, in your 40s, it's a really important time to get your retirement goals on track. So I'll just hand back to Lisa now for a bit more on how to start thinking about retirement at this stage, and hopefully taking advantage of some higher earnings that you have at this point.
Thanks, Rob. Often people come to me when they're sort of in their mid-40s, and the idea of retirement is really starting to come into focus. When people are in their 30s, it's really beyond their horizon. They should just do it. But in 40s, it starts to come into focus, and people often just don't know what they're going to need in retirement. And it does vary a lot from person to person. And there's a useful way of looking at it in terms of a minimum that you need, sort of a comfortable, moderate level, and a comfortable level. The Retirement Living Standards Organization and via the University of Loughborough have done some excellent research that they do every couple of years on what retirement is going to cost for people per year. And these are the figures that are on the screen now. So for a single person, a minimum would be £13,000. Now, a couple of things to mention. There's no rent or mortgage payments in these figures. They are assuming that your mortgage is paid off by the time you've retired and that you own your house or your home outright. That's the bad news for some people. The good news is if you have a full state pension, you're already almost all the way there. The state pension, which I'm going to talk about a lot more later, is £10,600 a year at the moment, and is going to go up depending on whether the government stays with the triple lock. But if they do, it's going to go up, I think, by 8.5%. So that's good basic income, but you will need a little bit more. For a couple, if they've both got the full state pension, then they're over the £20,000 minimum. Hi, Erica.
Hi, Lisa. Sorry to interrupt. Just a quick topical question here. Are these figures before or after tax?
These are all after tax. This is the amount of money that you will be paying for lifestyle, food, electricity, and that kind of thing. It's a good question. In terms of, if we just move from the minimum thing, looks at things like eating out in a restaurant once a month, going on one UK-based holiday. So that's covered there. For the moderate expenditure for a single person, it's £23,000, and for a couple, it's £34,000. So this gives you a little bit of more flexibility. You get looked at one foreign holiday a year, eating out a few times a month, and more of the things that you want to do, just to give a flavor of what moderate looks like. And then comfortable for a couple is 54,500, and for a single person is 37,300, and that gives you 2 foreign holidays a year, eating out more frequently, paying for a streaming service, and in general, more flexibility. Now, that's the amount of money per year, but it's not a straight line in retirement. I'll talk about this a bit more later, but essentially in early retirement, you're likely to be spending more because you're traveling, enjoying life. Then things settle down and you spend a little bit less. And then in the later years, you're probably spending a bit towards care and other expenses that may come out. But for someone in their 40s, sort of a good rule of thumb is for how many years are you going to be expecting to pay out £54,000, whatever it is? And sort of, it used to be that we could say that would be for 20 years-ish, but people's longevity have changed. The state retirement age has got up a little bit later. But sort of a good rule of thumb is take that number, multiply it by 20, and you'd have some idea of sort of the size of the pot that you're looking for. It can be quite scary. Don't forget, though, there's the state pension, which I've mentioned, and also there are investment returns, which can help. Back to you, Rob.
Thank you. And yeah, your 40s, as I mentioned, are kind of so many competing needs. And some people are looking to buy a home or purchase a larger one. If you've got children, they won't be sort of financially independent yet. So you've got all sorts of different things going on. So that's why kind of saving and investing for the future and thinking about what's further down the line, as Lisa mentioned, in terms of expenditure, can become a bit complex. So this is where having different goals with different timeframes comes in. You need to be kind of methodical and efficient about that, and sort of set goals for different pots of money, and consider whether they're short term or long term, as I mentioned earlier. And your goals don't just inform you about how you should invest, whether it's cash or whether you take on risk, but also the appropriate type of account. So it's really, really important to use what we call tax wrappers for your investing goals, such as a pension for retirement, or an ISA or individual savings account for earlier access, because you can use that to take out money at any time, and junior ISAs as well for children's longer term investing. And basically, by placing money in a pension or an ISA, you can save tax and make your investments work harder for you. And why is that? Well, an ISA or pension, all the income or the interest from investment is tax-free, as is any of the profits that you make on any of the investments within the accounts. So that's why you should prioritize these for your investing. You get to keep more of your returns. ISAs particularly popular. Not only they're tax-free, but you can also take your money out at any time. So they're really useful for almost any investing need. And also you have cash ISAs for cash, and you have stocks and shares ISAs for investments, and you can mix and match between the two. Not everyone knows actually you can transfer between the two types as well and keep your allowance. And always transfer rather than take the money out and put them back in, because otherwise you lose your allowance. But when you do take your money out, when you come to draw on your investment, there's no tax to pay. Pensions, meanwhile, Lisa illustrated the incentive of tax relief when you make the contributions, and that's really powerful because it adds to the amount you have compounding away. But there are a couple of limitations. You don't have access to your money right away. You've got to wait until 55 at the present time, and that's rising to 57 by 2028 as things stand. So this is future you money. It's stuff that you can't get at until you're in the later stages, but that's also kind of the point of it. So also bear in mind when you take withdrawals from a pension, they're taxable beyond the first 25% of the pot typically. So bear that in mind. But as things stand, that's very tax efficient, as people often move down a tax bracket as they move from employment to retirement in some cases. So if you get higher rate tax relief on the way in and then pay basic rate tax, say, when you're drawing on your pension, then that can be a win. Annual limits for ISAs and pensions, 20,000 for the ISA, up to 60,000 for pensions. That's gone up this tax year from 40,000, subject to a sufficient earned income, and it's 9,000 for a junior ISA. So that's the rules and limits as they stand, and they can of course change. So just moving on to the
Rob, sorry, quick topical question on this slide here.
Yes.
We have somebody saying, I have an ISA with CSD, but I don't seem to earn interest on the cash, only earn interest on tracker funds. Is this correct?
Interest is paid on cash in Charles Stanley direct accounts, but it is only credited to the account 6 monthly, which might explain why you haven't seen it. And the rates are on the site. You should be earning at least 2% on cash.
Amazing, good to know. And anybody else who's looking to be having questions answered, please do go ahead and put them into the Q&A box. Oh wait, one quick question. While you're still here, Rob, I'm going to ask you one more question.
Yeah, I should say as well that it's obviously a stocks and shares ISA, so it's not designed to be a cash ISA, but there is interest payable. Yeah.
Next question for you here, just because I have you. How does the LTA feature, especially with political flip-flopping?
Yeah, so the lifetime allowance is the amount that you can accumulate in your pension over the course of your lifetime. This might be a Lisa question. I mean, the Chancellor has just got rid of the lifetime allowance, but the chances are we may see it return with a different government. So yeah, I don't know whether you want to chime in on that one, Lisa, but yeah, it could well change. It could well change.
Yeah, no, Rob, that's spot on. What has happened is the tax charge, if you exceed the lifetime allowance, which used to be quite high, 55%, has been scrapped. It hasn't gone away completely. There's sort of a hidden way that the lifetime allowance still counts, which is in terms of the tax-free cash that you can take is a maximum of 25% of the current lifetime allowance. And I know, I believe that they're working very hard on the legislation to get this through, and they will, the government has to get it, I think is aiming for the end of the tax year, 2024, to get it through. But yeah, Keir Starmer has said that he will reverse it as well.
Good to know. Thank you very much, both of you. Okay, I'm going to go back to being hidden now.
Yeah, so if you just go to the next slide, please. I just thought I'd add something on mortgages. It's not something that we talk about a lot at Charles Stanley, but it's so relevant at the moment because of interest rates and how they've been rising, and of course everyone who's got a mortgage does face an ongoing choice whether they pay that debt down or invest any kind of excess cash instead. So that is something that people start to think about often in their 40s, as they might have a bit more expendable income. And as I say, with mortgage rates being quite high at the moment, it's definitely in focus. But the kind of answer to this is really complicated. It's definitely not one size fits all, because it depends a lot on the person's personal circumstances and very much on the terms of the loan that you've got. So your age and your job status are going to come into it. The interest rate, and importantly, really, it comes down to the approach to risk that you're happy with. And it can also hinge on the method of investing. And for higher earners, as illustrated in the slide Lisa talked about earlier, if you've got a leg up from tax relief that is as much as 40 or 45% tax relief, then that can tip the balance in favour of investing. And people do sometimes use their pension pots to help pay down their mortgage at a later stage. Although, you know, reducing your mortgage debt earlier on can save you thousands of pounds in interest over the course of your lifetime, and that also gives you a lot more peace of mind and puts your finances on a really sort of sound footing if you've paid down debt to a kind of low level or paid it off completely. And that's really liberating, and giving you that certainty is a factor in itself, I think, and it can be a really positive thing and actually allow you to maybe take more risks elsewhere. So it's a real balance. But if you're happy taking risks, the compounding of investment returns, you know, perhaps with tax relief, and certainly if you're getting tax-free investment returns over long periods, can be hugely powerful, provided your investment strategy is obviously sound. You've got a long enough runway really to deal with the inevitable volatility of stock markets. A lot of people are wondering, I think, where interest rates are going from here, and that's, you know, going to be a key factor. So if interest rates are high, then that really raises the bar in terms of your investment returns that you need in this kind of quandary. And recently, of course, they've been moving higher. But you know, the good news is that inflationary pressures are sort of easing now, and central banks are easing off the interest rates, the interest rate hikes. And if we haven't reached peak rates for this cycle, we're very close to doing that. We're not going to see the immediate benefits in kind of lower mortgage rates. It's going to be a gradual move lower, I think, in that respect. And certainly we expect interest rates, the Bank of England base rate, to be at this sort of kind of level way into next year. So we're not going to start to see lower borrowing or much lower borrowing costs. It's going to be sort of trickling down rather than a big fall. So as things stand, that means that sort of people on variable rates or people sort of taking out mortgages now got a period of kind of, you know, maybe a difficult period before things abate as the months roll on and the market starts pricing in those lower rates. If you do decide to pay off or pay down a mortgage, don't forget to look at penalties for doing so, because there are early repayment charges often applying in fixed and discounted periods in particular. And now I think it's back to Lisa for some for the next decade.
I'm going to whiz through a bit quickly because I won't have time to answer some questions. But essentially, the 50s are getting ready for when you are stopping working. It's getting retirement ready. A big part of that is the state pension forecast, and using, if you are a higher earner, to use high rate tax relief to accelerate your pension provision. Rob's talk about the mortgage, and you can also start thinking about succession and inheritance tax planning, with pensions are quite useful for that. Or I can skip the next slide, I think, and go straight on to the main points about state pensions. Okay, full state pension this year is 10,600. It's going up in April, probably by 8.5%. It will take us to 11,500. To get a full state pension, you need 35 years of contributions, possibly more if you were contracted out, and you need a minimum of 10 years to get anything. You do get a credit for the state pension in the years that you qualified for child benefits. So if you're looking after a young child up until the age of 12, you would get a credit for that. The age you can get the state pension is going up, 65 to 68, and you need to claim it. It doesn't get paid automatically, but they will certainly be in touch with you. You can defer the state pension and get slightly more per year. It's not a great deal more, but it is something. If you're short of years, you can buy extra years. People sometimes ask me, I've already got 35 years. Do I have to keep paying national insurance contributions? Yes, you do. Effectively, it's a tax. You have to keep paying them until you reach the state retirement age. So they're not voluntary, but confusingly, they are things which are known as voluntary pension contributions, and that's another topic for another day. I highly recommend to people who are in their 50s, actually possibly to anybody, to check your state retirement forecast and your contribution record, which you can do at gov.uk. Matt, you asked a question earlier, which I didn't fully answer. What size pot do you need to get? We have a pension calculator, and I'm sure there'll be a link sent around to everybody afterwards about that. So state pension is a really good building block for your income in retirement. Check your contribution record, and you can buy back missing years, but there's no need to do that until you're closer. I think you've got the window. You can always buy extra years, but there's some benefit to doing it earlier, and the window for that is, I think, April 2025. Next slide, please. Okay, so to get retirement ready, the first thing to do is work out what you have. You've been working for some years, you've probably left behind you a trail of old pensions as you move jobs. On the government website, there is a little tool to help you find where they are. It's if you Google track down my old pensions at gov.uk, it'll show you where they are. You put in where you worked, and it'll tell you who you need to contact to find out where your pension is. As I said, check your state pension, and also look at your other savings and investments. This all goes to funding your retirement. Work out what you're aiming for. Again, work out what you're aiming for. So I gave some numbers earlier, and we have our pension calculator so that you know. Don't go for the basic. Try to have something that you can enjoy life in. Check your employer pension and consider increasing your pension contribution. Simple, straightforward, very effective way of doing that. And finally, look at your pensions and see where they are invested. Rob was talking about investment strategy. You need to see the investment strategy of your pensions. And Rob's going to talk a bit more now about examining your investments.
Yeah, I think yes, by sort of the 50s is a good time to look at this, because for much of your life you could have taken a kind of set and forget type approach, so buying and holding a portfolio, adding to your investments regularly, and just sort of leaving things to chug along. But as you get older, it can be a good thing to really reappraise and ensure you've got the right strategy for the different elements of your investments and align them with your goals. So looking at sort of cash, we've already talked about quite a bit about cash, and it can be really tempting to keep lots more cash, especially with the eye-catching rates. But as I said, that's kind of the right thing to do for short-term spending and for goals. But if the money is set aside for the longer term, it is likely to be beneficial to invest that. And then turning to investments, do you have the right balance? So the last couple of years have really shown that market volatility can undermine your investment goals as you approach the time which you start to take drawing on your investments, which that alludes to the question that we had earlier about when is the best time to start taking the risk out, and as you move through your 50s, that's potentially something you need to start thinking about. When is it that you're going to be drawing on that pension? Are you using ISA as a kind of bridge to the pension before that income starts? Those are the sorts of things you need to be looking at and aligning the investment strategy when you're starting to draw on that money. What does that mean? Well, the asset mix might require adjusting. You might need to dial back the risk a little bit or tweak it to provide greater ability to generate income. And probably we're talking about later 50s here rather than earlier in the decade for most people. But it will really come down to the map of your future plans, the objectives that you have. So as I mentioned earlier, if you're planning on converting your pension fund into an annuity, so an income stream from an insurance policy that gives you a guaranteed amount, then it can be really worth reducing the volatility, reducing the investment risk ahead of doing that. However, if you're going to be moving into retirement and drawing on your pensions and keeping on investing them, also known as drawdown, then you'll need an appropriate strategy for that, and the two are completely different. So just to re-emphasize, really, make sure your investment strategy is appropriate for those goals. But don't also become too risk averse, because we've already covered the dangers holding of too much cash. Conscious of time, that's just the tip of the iceberg. But in the interest of time, I'll hand back to Lisa now so she could fill you in on how we can help further at Charles Stanley.
I mean, if you have a financial question and you want to speak to me or one of my team, you can book a 15-minute free call with us. There's a QR code there on screen, and we'll send around a link afterwards. We're very happy to help you if we can in 15 minutes, answer a straightforward question. We do also help people planning around the different decades. So we have a financial health check to check that all the fundamentals are in place and you're en route for retirement. Then we have at retirement planning options and planning ahead for retirement and inheritance tax. And also an hour-long session to go into things in more detail. But if you have a question, we're very happy to talk to you absolutely for free for 15 minutes. And we've helped a lot of people in 15 minutes, I will say that. Don't want to take too much time. So that's other questions, but Erica's going to help us with the Q&A now.
Yes, thank you both so very much for all that fabulous information. It's time now for the Q&A portion of the session. I am conscious of time. We will try to keep this brief, but we already see some answers, some questions rolling in here. So let's just get right to them. First question here for our experts. Is it worth opening or saving into a LISA? If I have more than 4K to save, what is the wise thing to do? Is it efficient to combine with the SIP? What do you guys think?
A LISA is really helpful in that you get a little boost, which is sort of roughly equivalent to a basic rate of tax relief. The catch with them is that is more than taken away from you if you don't either keep it invested until you're over 60 or spend it on your first home, which costs less than £450,000. So you do get a sort of a little bit of help towards your first home or towards your retirement, and that's great. But bear that in mind, because if you change your mind, you do get penalized a little bit. But I'm always going to encourage people to save tax effectively, and a LISA is another way to do that. You have to be under 40 to open one. and you can only contribute until you're 50, I think.
Yes. Next question here for Rob. Can you talk about the pros and cons of money market funds as a cash vehicle given higher rates rather than deposits? Rob, what do you think? Oh, you're on mute.
I'm on mute, sorry. What's the money market fund? It's basically funds are collective investments normally associated with investing in shares and bonds and other things like that. There is a sector, a couple of sectors where they actually invest in cash or near cash, or short-term lending, which are known as money market funds. And so these can be held in SIPs and ISAs. You can buy them through Charles Stanley Direct. The pros really is it's a kind of a cash proxy, and you'll get you'll normally get a return that's close to kind of the bank overnight lending rate, which is very close to the prevailing interest rate. So we're talking, competitive levels in the kind of 5% range at the present time. So that's kind of attractive. It's a way you can park in cash within an account. The downside of doing that as well, there's charges they tend to be quite small for holding the fund, but obviously there's charges involved in holding that versus cash. And they're not completely risk-free because there's a chance one or a number of the institutions that are being lent to could go bust. But it's obviously an unlikely scenario, but it's not totally 100% risk-free.
Got it. Thank you so much, Rob. A couple questions here about the state pension, which I do feel like have Lisa's name written all over them. Will the state pension actually be viable in 20 years' time? What do you think, Lisa? We know you cannot. You don't have a crystal ball, and you cannot see into the future.
I think this. My personal view is there will be a state pension. But it's going to, as people live longer and it's more expensive, it's going to be made later and later. And possibly the rate of increase in the pension will be unlocked from the triple lock, which basically means it goes up at the highest of national earnings, inflation, or 2%, and that's why it's going up at 8.5% this year, and it went up I think by 10% last year. So it may be changed a bit, but I think it will persist.
Thank you very much. Okay, next question here for Rob. Is it better to buy shares or funds for growth or for dividend payment? What do you think, Rob, our investing guru?
I love this question because because if you're actually investing for income, you're targeting dividend paying stocks, that's going to corral you into a certain type of company and certain sectors. So you're actually bringing more risks into your portfolio. You don't have as much diversification, but that is the traditional way of sort of paying yourself an income from the stock market. But as we've seen in the last couple of years, what's outperformed is just a really narrow band of technology stocks in the States. And you've totally missed that growth. So it's a hard question to answer, and because we don't know the future, because but basically if you go down the road of just taking the natural income and just having dividend stocks, then you don't have as well-rounded portfolio. So there's a compromise to be made. So my preference really would be a bit of both, kind of try and have some natural income that fuels your regular income payments, because you don't really want to be drawing capital and if you can possibly help it, but also you need some kind of kicker from the sort of growth side of things.
Thank you very much for that, Rob. A couple of questions here on inflation. I feel like this is a topic on many people's minds right now, with inflation being at the space that it is currently. One person is asking about the pension calculator. Does it take into account inflation? But also another person was asking about the figures you were giving earlier, Lisa, about the amount needed in retirement. Do those have inflation factored in, or what?
The figures that I showed on screen are in today's terms. So in 20 years' time, there will be much bigger figures. The pension calculator does take into account inflation.
Fabulous. Okay, next question here. Rob, where would you say we currently are in the economic cycle? Have we entered the contraction phase?
Well, I mean, I think there's certainly a big risk of recession in Europe and the UK and possibly in the US as well. So, we're very conscious of that. And actually, ironically, that's not necessarily a bad thing for markets if it's a relatively shallow contraction or recessionary period, because actually what that will probably mean is that inflationary pressures subside and that interest rates can't start coming down, and therefore the price of assets will be underpinned by that. People be more willing to pay up for earnings and for income. So we'll see whether that transpires. There's also a lot of inflationary pressures that are still in the system. Looking at the oil price this morning, it is quite worrying. But I do think that there is a significant recessionary risk out there.
Thank you very much. Okay, final question that we can do today, but as Lisa did mention, we're going to be sending around some information for a free 15-minute call with one of our experts. So if your question was not answered today and you would like to have it answered personally and then have a little bit more of a conversation with somebody, then please do stand by for the email that we have coming out. Final question here. If I pay national insurance for 25 years, does it mean I will get 70% of state pension when I retire?
Okay. I find it difficult to do the numbers on the fly. So you said 25 years. So that's 10 years that you're missing. So you're going to miss out on a proportion. But I would say go look at gov.uk. They will tell you the answer to your question.
You can plug everything in and it will answer all the questions there, right?
You don't have to plug it in. It knows what your national insurance record is and it tells you what you're due for.
Amazing.
But
Perfect.
that's the principle, isn't it? You get a proportional amount and you need at least 10 years to get anything.
Fabulous.
Yeah.
Okay. Unfortunately, that is all the time that we do have for today. We've already gone over so many great questions left, unfortunately, but please do stand by for that email. Thank you so much to both of our speakers for sharing your expertise and knowledge with us. And thank you to each and every one of you for taking the time out of your day to drop in on this webinar. This is definitely a medium that we're looking to do more and more of going forward. So we hope that you did enjoy. We hope you learned something. We hope your questions were answered, and we hope to see you at webinars in the future. We do have a list of upcoming webinar topics and approximately when they'll be, so please do keep your eyes peeled and check out our events page to register. Also, again, do look out for this email from us where you're getting lots of information, all the slides, and how to reach out to us for more help. We'd love to hear some feedback on what you guys thought about today's session, because we can only get better if we hear from you guys about what you want to be hearing. We'll leave the slide up for a little while, and we just want to say thank you so much again to everybody that dropped in today, and have a great rest of your day. Bye-bye, everyone.